there's a lot of uncertainty, right? Okay, should I sell so high already? Oh, it's been dropping a bit recently. Wow, Trump is going to talk to Xi Jinping in just a few days' time. What's going to happen? So, to help you assuage some of your fears and answer those questions, we're very pleased to begin today's session with a very insightful segment by the Managing Director, Investment Strategy, Wealth Management Unit at OCBC Bank. He'll be sharing the latest investment outlook and, of course, the market updates. Please welcome on stage, Mr. Vasu Menon.
Very good afternoon, everyone. Thank you for taking the time to be here this afternoon. And thank you to the CPF board and MAS for inviting me as well to give us a chance to share our views on the markets. 1 year ago, on the 2nd of November, I was standing on this stage sharing the views on where the markets are headed. It was 4 days before Trump got elected as president of the United States. And I still remember there was a lot of nervousness in the markets, right? On the 2nd of November 2024, S&P 500 index was 5,728. Last night, the S&P 500 hit an all-time high, up 19%, roughly over the last 1 year, right? So I still remember at the point in time, 2nd November 2024, a lot of worries whether Trump is going to derail the markets. And our view at the point in time was that the outlook is still sanguine, positive, and we've been proven right to some extent. So where do I stand right now? We are now into the roughly third year of the current bull market. And I think the very first chart tells you, in a summary, in a nutshell, where we think the markets are headed. We are medium-term positive in the market still, as we were a year ago. And let me start my presentation by first showing you how the markets have done so far this year, right? So it's been a year full of twists and turns. A year full of uncertainty, a year filled with fear and joy. And what you see is, markets have done very well. Global equities up 18%, global bonds up 8%, right? US equities roughly 15%, Japan roughly up 20%, Europe up 27%, Asia ex-Japan up 29%, right? Roughly. And one of the best performing sectors has been technology, and the star performer, the absolute star performer, has been gold, up 57% so far this year. So I remember at the beginning of this year, lots of skeptics in the markets, lots of headwinds, what Edward just spoke about, right? We are worried about this and that and this and that, surging peg and Trump. It'll always be there. It's a fixture, right? You should not let the noise distract you from the bigger picture. Now, if you look at this chart, it tells you that corrections in bull markets are normal, right? So this current bull market started at the beginning of 2023, right? The bull market for stocks, I mean. And if you look at the market since then, we've had at least 5 periods of significant correction. Of course, the big one was a 16% correction when Trump announced Liberation Day tariffs in April this year, right? But each of those corrections were a buying opportunity, right? Because the markets pulled back and they went up again. So markets never go up in a straight line. So, investors who think that bull markets are just one track, unabated, no, it doesn't work that way. Imagine yourself doing a sprint. Are you able to just sprint forever? No, you got to stop. You got to catch your breath. And the markets are just like that. So you must expect the markets to pull back from time to time. It will happen. But does that change the trend? Answer, in our view, at least, is no. Now, when we look at the market outlook, we tend to look at several factors. Economy and earnings, interest rates, inflation, liquidity, geopolitics. So what I've done is I've put it all together in this schematic chart that you see over here. And geopolitics has now become a major driver of the markets. And geopolitics is encapsulated in US tariffs, right? That has an impact on economy and earnings, inflation, interest rates. But what's supporting the market is liquidity. There's an abundance of liquidity right at the bottom supporting the markets, right? And I'll show you a chart in a short while what I mean by that. So this, in a nutshell, is what drives the market and what supports the market. Now, Trump has increased tariffs, the average tariff rate in the US, from 2.4% last year to now almost close to 20%. So it's gone up almost tenfold, right? But it hasn't derailed the markets, right, as many people feared. Now, Trump is not necessarily bad news for the market. So last year, as I said, I gave my talk on 2nd November 2024, roughly 4 to 5 days before Trump became president of the United States, and there were a lot of fears. Trump is bad for the markets, it's going to cause the markets to derail. But if you look at Trump 1.0, it has not caused the market, he has not caused the markets to derail. I mean, 2017, when he first became president, the markets had a good run. 2019, 2020, the only time was 2018, and it wasn't because of Trump. It wasn't because of tariffs. That is the year that Trump launched a trade war against mainly China and many other countries. But it wasn't the trade war that caused this sea of red that you see in 2018. It was the Federal Reserve. It was Jerome Powell who pushed up interest rates sharply in the fourth quarter of 2018 that caused the markets to pull back. And guess who appointed Jerome Powell? Is Trump. He appointed Jerome Powell in 2018, and Powell did exactly the opposite of what he wanted him to do and pushed up interest rates and got Trump very upset. And that caused the markets to pull back. But other than that, the markets have done relatively well under Trump. Now, I think a key question to ask is, are the economies going to earnings? My own experience in the markets tells me that, if we don't have a recession, that's relatively good news for the markets, right? And these are numbers coming out of consensus forecasts taken off Bloomberg. So it's not my forecast, it is taken from thousands of economies around the world as an average forecast. And I think, most of them are not forecasting a recession. So that's good news for equity markets. Now, what about the Federal Reserve, right? They should know probably more than many of us. And they are not forecasting a recession as well. In September, they unveiled their economic growth forecast for the US, and they're looking at the US economy growing at 1.8% in 2026, 1.9% in 2027. So they are not forecasting a recession. Now, what about earnings recession? It's not just economic recession, but earnings recession as well. And again, we are not seeing an earnings recession. Analysts are not forecasting an earnings recession. So every time earnings season comes around, everybody's nervous, but earnings have exceeded market expectations for several quarters right now. So the current earnings season is going on. Again, it has exceeded market expectations, right? So earnings has not been a big headwind for the markets. Now, if you look at Trump 1.0, when he imposed tariffs, you do not see inflation spiking up, right? So the fear that tariffs is going to cause inflation to go up sharply has not happened. And what has happened in 2018 is you see a bump up. 2017, 2018, you see inflation going up slightly, but then it comes down again. So in our view, inflation is going to be a price shock, but it's not going to cause the tariffs are going to be a price shock. It's not going to cause an inflation shock. Okay, there's a difference between price shock and inflation shock. It's going to cause prices to maybe go up a little bit, but even then, if you put all that aside, there are various reasons why the tariffs have not caused inflation in the US. In case you don't realize, right, in the US, only 10% of goods that are consumed in the US are actually imported. 90% are produced domestically. So inflation has a limited impact on the CPI or inflation index in the US. Now, if you look at the inflation indicator, this is what the Fed looks at, the US core PCE inflation rate. It has not gone up. It is a bit sticky, it's not coming down, but it's not spiked up as many people feared. And in fact, if you look at the red writing on the chart, it tells you what the US Federal Reserve is forecasting in terms of inflation. And they are expecting inflation to be relatively sticky at 3.1%. The Fed's target is 2%. They are looking at 3.1%, but it comes down in 2026, 2027, which is the point that inflation tariffs are going to be a price shock, not an inflation shock. So these are forecasts taken off the US FOMC. Now, what are the markets expecting in terms of interest rates going forward? Now, the markets are expecting the Fed to cut rates quite a lot. So next week is the FOMC meeting, and the markets are expecting the Fed to cut rates. And the markets are expecting the Fed to cut rates by about 125 basis points in the next 1 year. Now, I'm not sure whether that's going to play out. The markets are expecting 2 rate cuts this year and 3 next year. And rate cuts are important because, rate cuts actually will unleash that liquidity, the massive liquidity on the sidelines into the markets. So this is what the markets are expecting. Now, even if we don't have 5 rate cuts and we have 3 rate cuts, I think that's still good news for the markets, right? We'll have to wait and watch, but I think it's quite clear that rates are headed lower. Now, if you look at history, it tells you that historically, if there's no recession and there are Fed rate cuts, the markets tend to do quite well, right? No recession, Fed rate cuts, markets do well. This has been proven historically. And right now, no recession, Fed is cutting rates. I leave you to draw your conclusion. Now, this is a chart I talked about earlier, record liquidity. You've got US money market funds, which is a benchmark, a kind of indication of liquidity. More than $7 trillion sitting on the sidelines. $7 trillion, massive mountain of liquidity. Now, if you go back to 2007, 2008, 2009, when we had the global financial crisis, we saw a big buildup of liquidity. But when the things started looking a bit better, that liquidity went back into the markets and fueled a rally. Right now, it has not gone back into the markets in any meaningful way. It's still perched up there. Now, can you imagine what happens when it starts going back into the market in a more meaningful way, right? That will provide the markets with quite a bit of support. So there's a huge amount of liquidity on the sidelines. And what does the liquidity reflect? It reflects the level of bearishness among investors. And what I sense is some degree of cautious optimism. So the poll results kind of shows it. I mean, almost 35-40% of you are bearish on the market. 60% are bullish. I'm looking at almost 40% bearish. To me, that's music in my ears. It tells me there's still firepower on the sidelines, which can provide the markets with support. Now, if 90% of you are bullish, I will worry. Then I'll call it euphoria. We don't have euphoria, right? We have cautious optimism in the market. Lots of money still on the sidelines. And I want to end my presentation by telling you that, we are positive once again on the medium-term outlook, as I was on 2nd November 2024 when I was here. Again, we are positive on the medium-term outlook. The bull market in the S&P 500 index has typically lasted 5 to 6 years, historically, on average. If you go back all the way to the 1960s, average bull markets have lasted 5 to 6 years. We are now into the third year of the bull market, which implies that historically there is room for the markets to potentially hit higher, supported by liquidity, the Federal Reserve, and hopefully economic resilience. So we don't anticipate an economic recession. We think that's good news for the markets. And don't forget, next year, Trump's tax and spending plan, also called OCBC, or the One Big Beautiful Bill Act, as he calls it, that's going to provide the market with fiscal support in addition to monetary support from the Fed as they cut rates. So the potential rate cuts in the Fed is going to be good for the markets in terms of unleashing liquidity. And clearly, there's a lot of liquidity on the sidelines that hasn't made its way into the markets yet. So we think that markets will pull back. Don't expect it to go up in a straight line. So there will be pullbacks. But these pullbacks, we think, are an opportunity for investors. So remember that volatility is a two-sided coin, right? On the one hand is risk, on the other hand is opportunity. So don't just focus on risk, focus on the opportunity as well. So what we're saying is stay invested, but of course manage your risk through a regular investment plan and through a very diversified portfolio. And I'm very heartened to see the poll results show that most of you have got at least 3 asset classes. That is diversification. So I just want to end my presentation by saying this. Investing is not a race. Investing is a well-planned journey. Patience pays. But if you're trading the market, that's not investing. So investments is about making sound financial decisions and staying the course, right? And we think that, the medium term is still positive and there's still a case for investing in the markets. So with that, I thank you. Hand you back to Edward.
Thank you very much, Mr. Vasu Menon. So for those of you who came last year, you realize that it's actually quite profitable to come every year and listen to him. Very good advice. And words of wisdom there, absolutely. The whole point of why we're here is about investing carefully and investing well for the long term. We're not here to tell you to take big bets for the short term. We're telling you if you invest for the medium to long term, invest carefully, and you allocate to a well-diversified portfolio, you should be fine. Now, on that topic, because a lot of us find it challenging to decide where we're going to invest in and how much to invest in. There's so much uncertainty. A lot of us, as he mentioned earlier, Mr. Vasu mentioned that there's $7 trillion sitting on the sidelines in money market funds. A lot of us are actually scared to dip our feet into the markets. So how do we start? Where do we get started? To guide us, we have the investment counselor from Citigold Private Client Wealth Management. Please welcome on stage, Miss Audrey Ho.
Good afternoon, everybody. Thank you all for joining us today and dedicating your Saturday afternoon to learning more about the financial markets. So my name is Audrey, and I sit with the investment team in Citi. So I provide investment advisory to a lot of our Citigold private clients. And today I was asked to speak about turning uncertainty into opportunity. I think from this perspective, in many conversations that I have with clients as well as with money managers, one thing I notice is that it's not so much that investors are not getting enough information about the markets, but it's more of how do you interpret this information? Is it news? Is it noise? And what kind of actions should they be taking on their investment portfolios? So today I would like to speak about uncertainty from the perspective of common pitfalls or common behavioral patterns or blind spots that all of us may exhibit as investors. And hopefully this will help us in our decision making as we continue this investment cycle together. Okay, so the first so-called blind spot that we notice is that rates have been high over the last 2.5 years. And that has led to many investors being overweight in their cash positions. Over here, what the chart shows you is, if we look at the line in green, that shows an invested portfolio. So a 60-40, 60 into equities, 40 into fixed income. That shows an invested portfolio over the various time periods. We have annotated 3 different so-called recessionary periods. Firstly, during the dot-com bubble in 2000. We also looked at the financial crisis, of course, in 08 and 09. And most recently in 2022 was the inflation shock, in which many developed markets around the world saw inflation going up to double-digit levels. So here we can see that, just using one kind of timeline as an example, markets were rising for 13 years post the financial crisis before a correction in 2022. So monies that were invested post the financial crisis would have gone up more than 3 times before selling off close to 20-25% in 2022. So the kind of key message that we'd like to share today on this topic is that the fear of market crashes as a reason to hold excessive amounts of cash in a portfolio, this decision has been very costly for many investors as they have missed out on performance. And this is something that we'll like to revisit at a later stage. So this graph looks a lot like Mr. Vasu's graph that he shared earlier. The second topic that I'd like to share today is around volatility and risk. And this is something that I feel is very, very important. We are currently living in a very hyper-connected world, and very often we see, we're constantly bombarded by news headlines. We don't know whether it's news or noise, and that has led to many of us mistaking the concept of volatility and risk and using these terms interchangeably. However, I would like to just share a couple of the meaningful differences today. If we look at risk is the worth of an asset. So, the less worth a company is, that means to say that the more risk you're taking and correspondingly the return that you should be getting should be higher as well. So that is a fluctuation in value. However, if we were to consider what volatility is, that is more of a fluctuation in price. So this tends to be a lot shorter lived, and also it's more based on market sentiment versus the actual change in the fundamentals or the worth of an asset. So this is very common because I think this misconception is especially relevant today in our very hyper-connected world. In this graph, we show 3 periods of arguably high levels of volatility. 2017, that was when we saw the renminbi devaluation. 2018, like what Mr. Vasu says, that was President Trump tariff war, trade war version 1. And then, of course, we saw a great amount of volatility in 2020 during the sell-off, the pandemic-related sell-off. So for investors who had stayed the course and had taken volatility as their friend, were actually rewarded very handsomely, as you can see in this chart. Okay, so very often nowadays, we are also getting a lot of questions from clients because they're concerned around the many geopolitical events that have been happening around the world. So what we've done is, if we were to pull back for the past few decades, going all the way back to the Second World War in 1940s all the way to now, what is the impact of all of these geopolitical events on investment portfolios? So, okay, I think it's a bit small, but I would just like to direct your attention to most recently in 2022, where we saw Russia's invasion of Ukraine. So Russian invasion of Ukraine 2022 February, the initial reaction of the S&P was negative, understandably, on the day of the invasion. However, we note that there isn't actually a change in the fundamentals of many companies around the world, which is why the S&P turned into positive performance just a month later. So this clearly shows a fluctuation in price more than the risk profile changing. However, if we look at the next column, which shows the performance of crude oil, okay, there we see a very big difference, because on the day of the invasion, oil popped, call it 20%, and then subsequently managed to retain that high level of performance over the next 1 to 3 months. So this suggests that things have changed on a fundamental level, because Russia is seen as a large exporter of commodities, which is why there is a clear distinction here. The S&P saw volatility, saw a fluctuation in price, and in the case of commodities, it was more of change in fundamental, change in value, and that is where the risk profile has changed. So this heat map here shows the performance of different asset classes over the years, over the last decade, from 2014 to October 2025. And what we see here is that there isn't one single asset class that is able to perform the best on a rolling year basis. Which means to say, as what the polls earlier showed, if you as an investor were diversified across, call it 2, 3, 4 different asset classes, that would have made your investment journey a lot smoother and generally less bumps along the way. And this is important. If we go back to the first point on being overweight on cash, you would notice that cash is at the bottom end of the performance over the last 10 years. If you had held cash for the last 10 years, your annualized return would have been 1.8%, which, as we know, is kind of hardly enough to cover or cope with the levels of inflation around the world. So this is exceptionally important, because over the past few years, we have seen that certain sectors, certain geographic regions have outperformed in a very, very meaningful way. And that has led to the relative weight in investment portfolios getting a lot bigger. So if I had invested in the tech industry, for example, a couple of years back, 30% of my portfolio in the tech industry, that could be 60% now or even 70% now. So that would have an outsized, disproportionate impact on the overall risk profile and the overall volatility, as well as the returns on my entire investment portfolio. Very often as well, nowadays, we are getting a lot of, we sense a lot of uneasiness, and we're getting a lot of questions on the concentration of US equities or the exposure to US assets in an investor's portfolio. And this uneasiness is warranted, because if you look at the chart on the left, it does show that more investors are piling into the US market than there are of US companies contributing to global earnings. So how we interpret this is, if you look at the black line, that shows US as a percentage of the global market cap. Out of all the equities that are out there, the US is currently 70 to 75% of the global market cap. But if you look at the line in blue, that shows out of all the earnings of companies around the world, only 50% comes from US-related companies. So that divide means that there are a lot more assets out there of companies that are producing earnings that have yet to be explored or invested in by many market participants. On the right, in the in that little 4 different charts, we also show a similar thing. On the top left, we've spoken about US market as a percentage of the global market cap. That is about 70 to 75% since 2015 till now. However, if we were to look at Europe during the same time period, from 2015 to now, Europe has gone from 25% to, call it 15% of the global market cap as it currently stands. And if you look at Japan on the top right, Japan, during its heydays in the 1990s, used to be 50% of the global market cap. It is now less than 5%. So, the main message here is, unless we think that the US has gone from 50 to 75% and then subsequently to 90% of the global market cap, then perhaps there is kind of little to lose to consider looking at other sectors, other geographic regions as viable investment options. Okay, so some observations over the past 4 bear markets. We mentioned the dot-com, the financial crisis. I've also included the COVID sell-off, the pandemic sell-off in 2020, as well as the inflation shock. So 2 main observations here. The first one is that the duration of these market cycles are getting a lot shorter. If you look at the duration of what used to take years to unfold is now happening in a couple of months. And similarly, if we were to look at the recovery the timings, that has gotten a lot more compressed as well. So during 2000, 2008, it took a couple of years for the economic activity to restart, for businesses to resume, for stock markets to go back up to the initial level. It used to take a couple of years. But right now, in 2020 and 2022, it took just a couple of months. So there are many reasons why market cycles are becoming a lot more rapid compared to before. Mr. Vasu mentioned around having a lot of liquidity in the system. That could be one. But also the rise of algorithm trading, in which computers have specific levels in which large volumes will be executed. All of this has distorted trading activity. But the main point here is a question that I'd like to pose to everybody in this room, and this is something that I think you will find very familiar. How often have we said that we are putting aside X amount of dollars to deploy into the markets when there is a correction? Right? So I see many kind of smiling, knowing faces, because that is something I think everybody is thinking about, myself included, and I'm sure many of the others are thinking the same thing. So the 2 assumptions that are present here, the first one is that there is no opportunity cost of waiting. And the second assumption is that we are disciplined and we are brave enough to act and deploy money into the markets when everybody else is in a panic. So I'd like to dispel both of these assumptions today. On the left, we can see that the markets wait for no one. So often we see many investors who were exited in 2020 as a result of the pandemic. They found it difficult to re-enter into the markets as the market staged an almost V-shaped recovery. And on the right, we see that the best days in the market often happen during the worst days as well. So if you had invested $100 from 1990 all the way to now, that's 35 years, your money would have grown by 3,800%. That's about 10 to 11% per annum. If you had missed the top 5 days during that period, your return profile would have been reduced by almost a third. And in a very, very exaggerated example in the bar chart all the way at the bottom, if we had missed the top 50 days in the market out of 35 years, and just before I came on stage, I went to calculate 35 years equals to 12,800 days. So out of 12,800 days, if we had missed just the top 50 days in the market, we virtually would have had no return on our investment portfolio. So, for many of us as long-term investors who are hoping to build that long-term retirement portfolio, perhaps time in the market is infinitely more efficient than trying to time the market. Okay, so the last point today that I'd like to share is around growth. So the thinking behind growth stocks. Very often we like to extract value from everything, right? Whether or not we are buying things at a sale or whether we're buying companies at a sale. If we were to look at value as, if we break down value is typically broken down into 2 different subcategories, defensives as well as cyclicals. The returns profile, the earnings profile of many of these companies have been trending down over the last 2 to 3 years. And concurrently, if you look at the same time period, many of these growth companies have had multiple earnings revision upwards. And we have also seen that in the case of many of the large cap companies, they've also had improving fundamentals, whether or not it's earnings or whether they're paying off debt or holding an increasing amount of cash. So ironically, over the past few years, we have seen that growth stocks have actually exhibited a lot of defensive characteristics. And then your next question or your next so-called objection would then be to tell me that, Audrey, if you're looking at growth companies, that's highly volatile, and that's not suitable for my investment journey. And so the next thing I'd like to suggest is maybe if we were to consider dividend growers as an alternative. Dividend growers, as you can see on the left, the return profile of dividend growers compared to growth stocks, it doesn't disappoint. And on the right, we see a much smoother investment journey because the fluctuation in price, the volatility is a lot less compared to growth stocks. Okay, so with that, I hope that the 5 concepts that I've shared today have made us all a bit more aware in terms of the common investment blind spots that we may exhibit as investors. And hopefully, this can help us in our decision making when it comes to selecting investments for our portfolio or portfolio construction. Thank you.
Thank you very much, Audrey. I'd like to invite you to take a seat just on the chair to your right. And Audrey, we're going to ask our other speakers to join you on stage now. Please welcome back Mr. Vasu Menon, of course. Big round of applause for him. And he'll also be joined by the Assistant Director of Investment Advisory at iFAST Global Markets and the co-founder of Dr. Wealth. It's a website and a Telegram group you probably want to join. Please welcome also on stage Mr. Alvin Chow. So before we start the panel, I have to do a bit of advertisement for Money Sense. It's their logo right up there. So Money Sense will help you if you're interested in building stronger foundations in saving, investing, or planning for the future. Check out their basic financial planning guide on their website. They spent a lot of time to put it together. There's a lot of great practical advice there tailored for every stage of your life. That's on the Money Sense website. So now I'm going to go to our speakers. We've got quite a few questions for you, but also from the audience, you can submit your questions as well. We're going to put a QR code on screen. And please do scan that QR code if you'd like to submit questions to our panelists, whether to Vasu, Audrey, or to Alvin. Vasu, I'm going to start with the first question for you. And I promise you, this is going to be an easy one. I'm going to start because we've been hearing from both you and Audrey, you've been quite positive, actually, on the markets, quite risk-on. So I want to ask you what the biggest risks are right now that you see for the markets.
Yeah, I think it's important not to be complacent. That's quite important. To me, one of the risks that I see, I see a few risks. Of course, the risks will always be there. One of the risks that I see is President Trump tinkering with the Federal Reserve, right? So, Jerome Powell's tenure as Fed chairman ends in May next year. And the Federal Reserve Board currently comprises of 7 governors, right, including Jerome Powell. And right now, you have 3 Trump allies in there, and you got 4 non-Trump allies, if you can call them, in there, including Lisa Cook, who Trump is trying to fire. And it's before the Supreme Court right now. And maybe you'll get a ruling in the first quarter of next year. So, if for whatever reason Supreme Court rules in favor of Trump, and Lisa Cook is out, then Trump is able to put somebody in there and tilt the equation from 3-4 to 4-3. And then when Powell steps down as chairman,
that's in May next year,
That's in May next year, 16 May next year. He could put another person in there that will then tilt it to 5-2, which is a scary thought because it means that, he will then be able to, in ways, control the Federal Reserve. And I think the markets won't take kindly to that.
Can I ask you about the why do people think that's a bad scenario? Because right now he controls, for example, the Supreme Court already. It's very pro-Trump.
Agree.
A lot of people have seen that. Why do the market players, market participants, feel that there may be a risk if Trump also controls the Federal Reserve? That's
right. So the Supreme Court has not ruled in his favor in all cases, right? Now, if it's 5-2, then there's a chance that, his allies could actually push for further rate cuts because he's talking about big rate cuts, which is good for investors typically. But at the same time, if that results in excessive rate cuts, and it results in fueling inflation as a consequence, that's not good news for the markets in the medium term, right? And the other thing is also that, I think if you look at history, whenever there's a crisis, who provides a backstop? It's the Federal Reserve. They come in with swap lines, they provide the backstop. Now, if he controls the Fed, he might say, look, the Fed is going to be no longer there supporting the global markets. You're on your own. This is make America great again, right? So there's a risk of that happening, right? But having said that, you are right. Right now, he's got 3 allies in there. What's interesting is the most recent FOMC, you found 2 of them, Chris Waller and Michelle Bowman, did not really vote as he wanted, right? They voted for a 25 basis point cut. The guy who actually voted in line with what he wanted was Stephen Miran, his latest addition for the Federal Reserve who wanted 50 basis point rate cut. So, we also have to give some credit to these governors who come in, right? They've got a mind of their own. They will not do anything too crazy. So let's hope that happens. But of course, the markets are going to be nervous about it, right? But let me just add a caveat here. Now, the Federal Reserve Board comprises of 7 members, right? But the FOMC that decides rates comprises of 12 members. So the Federal Reserve Board is 7, and then the additional 5 come from what they call regional Fed presidents. Now, these regional Fed presidents are appointed by the Federal Reserve Board, not by Trump. Trump appoints members of the FRB, but the regional presidents are appointed by the Federal Reserve Board. Now, if Trump is able to control the Federal Reserve Board, he can then start putting regional Fed presidents that so that could change as well, and then tilt the whole FOMC in his favor. So the initial reaction might be one that's nervous, but as you said, the markets have had time to internalize it. Hopefully, it will not be as significant.
So I'm going to go to Audrey now. That sounds scary. When we hear from Vasu saying these things, oh, so Trump could do this anytime. He's already torn down one side of the White House. He can stack the Supreme Court. Now he can stack the Federal Reserve. When people hear things like this, they tend to get a bit scared. They're thinking, oh no, I better go look at my portfolio. I better look at rebalancing it. How often should we be reviewing or rebalancing our portfolios, Audrey?
Okay, I think the fact is fundamentals of many companies, they don't change as quickly as news headlines go out, right? So what we've seen is, as I mentioned earlier, around the difference between volatility and risk, if we are able to differentiate as a result of all these news headlines, whether or not it's whether it's Trump or whether it's the Fed president, chairman, etc., what is the impact on the companies, on the fundamentals of the companies that you are investing in? I think for many of our clients and many investors that we have seen, for long-term portfolios, I guess every month, every quarter, that tends to be quite a healthy look, healthy range to start looking at your portfolios. For more concentrated positions, of course, a closer watch is necessary. But in this case, it is very, very important not to confuse that volatility and risk. At the end of the day, Trump is going to be in office for, call it, 3 more years. Next year would be the midterm elections. So, despite everything that he does, I think it is in his DNA to want to show that, he pegs his identity to the stock market. And I think he's not going to want to rock too many boats next year going into the midterm elections.
So at least look at it 4 times a year, at the least. Probably.
Yeah, I think for many of us, retirement portfolios that are meant to be long term, maybe 4 times a year. I think that would be good. We need to also assess if we are rebalancing for the sake of it. Let's not go there because I read this phrase in the book that really stayed with me: not to confuse progress or motion with progress. Right, so the analogy that they gave was that when the airplane stops, a lot of people immediately get up to try to get stuff from the overhead compartment, but the doors don't actually open for 10 to 15 minutes, right? So there is a natural impetus for all of us as humans, as investors, to want to move and get things done, but there is no actual outcome. So when it comes to our investment portfolios as well, don't rebalance for the sake of it. Consider what you're rebalancing into. What is the basis for why you're switching out one asset for another? The understanding there is very, very important. And then, of course, consider the costs that are associated with rebalancing as well.
Yeah, sometimes the best move is to do nothing. Yeah.
But yeah, I mean, it depends on the fundamentals, I think.
I'm going to go to Alvin now. So speaking of wanting to do things when you hear about things, a lot of us now get our news from social media, from TikTok, from Douyin. There's a lot of people out there saying different things, and sometimes you don't know where these people are from, who they're speaking for, why they're saying these things. And it's led, I think, to some rather dubious advice on the internet. I'd like to hear your views on this. You've been in the space of financial literacy and helping people manage their finances better for quite a few years now. What are your thoughts?
I would say that the internet is both a boon and a bane to investors, right? So one is nowadays you get access to information a lot faster compared to the past. I still remember in my growing up years, I see adults checking the teletext for stock prices. Okay, so roughly you know how old I am. And today, you can just whip out your phone and you can just check the app. You can get live prices. So these are good things that investors have a lot more access to information, faster information as well as compared to the past. But the bad thing is you also get a lot of unsolicited advice, sometimes may have ill intentions. And I think for online kind of information, there are at least two areas of concerns. One is the scammers, right? Definitely, we have seen it in the news, getting more and more cases. The amount of money that's being scammed every year is a lot. So I do think that it is a very key watch area for all of us. And the second would be the ill advice, right? Sometimes it may not have bad intention, but because online personalities, they may want more eyeballs and they need to sound more interesting, and they may sensationalize certain things, and that's where things get a bit out of hand and you might just invest wrongly, right? So that's where I do think that we need to be careful as well, right? So these two areas are a watch area for me on the internet.
Actually, related to that is listening to people who you actually know and trust. Your family members, your friends, you know, your auntie will come and tell you, hey, I heard about this thing. They've got a durian plantation, you want to invest now. Every year got 12% returns. You know, when you hear about things like that, how does that make you feel?
I guess if you have a personal yardstick of what is realistic returns from the markets, you will know, right? So maybe I give an example, real life story. A friend of mine asked me about gold investment. It's not recently, okay, it's many years ago, but I'm very sure some of you would have been asked to invest in gold some way or another, and you need to be careful about that because usually scammers like to ride on anything that's very hot. And we know gold, just now Audrey and Vasu already show you gold is the best performing asset this year. Be sure that there will be a lot of scammers coming around and talk to you about gold, so be careful about that. So the case happened many years ago. My friend suddenly texted me and said that, oh, I wanted to invest in this gold product that pays me 5% every month. Sounds good, right?
5% a month.
5% every month, right?
5% per month.
Wow.
So yeah, some of you know that it's a scam, right? Because you have a yardstick of market returns. You know that sounds too good to be true, right? But if you don't have the yardstick of return, you might think that, oh, that is normal, and you might just invest in it because you think that, oh, gold is a rising asset right now. And I told him that gold doesn't pay dividends and doesn't pay its interest. Where would that cash flow come from? Right? Unless you shift off the part of the gold and then you sell every month, right? And convert to cash. And I also mentioned that 5% a month, that means that it's almost 80% a year, right? Close to 80% a year compounded. And even if a very good year for gold this year, you saw it's like 40-50%. Again, it's not realistic, right? You have a yardstick of performance. And you look at 25 years, longer history for gold is about 10 to 11% per year, right? So nowhere near is going to be 80%. Right? So as I said, don't make any decision now. You mull over it and you can decide tomorrow. Okay. So I think that is also one trick that you all can use. Do not commit anything immediately because scammers or whoever will always want the urgency to push you and tip you over when you're emotionally charged. So calm down, and I told him that, and it's a good thing that he didn't invest in the end. So I do think that this can be a good lesson. I think everyone can learn from.
It's something scammers always tend to do. There's this urgency, right? They tell you don't do it now, you're going to miss out on this opportunity. Also a reminder for everyone, there is an MAS alert list, okay, of all the blacklisted or companies that you should look out for. And also you can check if people are MAS licensed. So if they should be giving you advice. So I want to thank everybody for submitting your questions. If you can put the Menti code back on. We've got 40 questions ready. So we're going to get through as many as we can before 2 p.m. Next question, I think, is for everyone. I'm going to open this up to all the speakers. Just jump in if you like. We've got one of our audience members who says, I'm 58 this year. Is it too late for me to start investing? What do you think?
Okay. I'm older than you. I'm 62. So, so I guess I have the right to offer some views, given the fact I'm an old man, senior citizen. I don't think it is. I don't think it is. I myself am still investing in the markets. I think it's a matter of how you invest in the markets as you become older. So for me, I've got very young kids. Married very late, very young kids. So to me, at this juncture, my wife is still working, so I'm the sole breadwinner. So essentially, when I invest in the market, these are my circumstances, which I'm sharing. I will, of course, I'm interested in growth, capital gains. That's important to me. But at the same time, you know, a good chunk of my portfolio is invested in income-yielding assets, things that give me income. But of course, I do my research carefully before I invest in it. And income is quite important to me as I become older. Because when I retire, I will need that income to continue supporting my family, you know, and paying the bills on a monthly basis, right? Because, you know, nobody can work forever. So when you stop working, you need income, right? But at the same time, you also want to make sure that part of a portfolio grows. Because income, you can get maybe like 4%, 5%. If you put it in the US dollars, maybe slightly higher. You know, and depends on when you invested. You know, if you invested a long time ago, your yield could be a lot higher. But you also want to get capital gains because then you want to fund your children's education, even your own retirement. So I think essentially when you're younger, you can take more risks with equities. And but as you become older, I think your risk profile also should tone down. And you should perhaps invest in asset classes that are a bit safer, income yielding, or at least that's my experience.
Thanks, Vasu. Audrey, I'm going to come to you on this because the follow-up question is, there is a young investor here who says that I'm just starting out. What would a good diversified portfolio look like for me in terms of allocation to sectors? Should I only focus on the US market? It's been doing so well.
Okay, so I get for many people who are starting out on the investment journey, this is a very good time to be looking at investing in the markets, right? Like what Alvin says, the information asymmetry is not so much here today compared to before. You know, what used to, you need to check teletext, nowadays you just log into any app and you can easily find prices, you can easily find information. So for a young investor, this is a good time to start looking at investments. Whether or not you're a young investor or whether you are 58, I think it's very important. Two concepts are very important, which is firstly, understanding. So when you're starting out, whether you're young, whether you're old, when you're starting out, it's very important to understand the product or the asset class or the actual company or the investment that you're getting into. At the end of the day, the purpose of investing is not to try to help you get like 50, 80% returns, but to, you know, you should be able to sleep well at night. So the understanding of the product is very important. And then diversification, it is always said that diversification is the investing world's only free lunch. So whether you, in no circumstances should we have our portfolio entirely concentrated in one particular sector or one particular asset class. According to, you know, the heat map that we showed earlier, there isn't one asset class that's able to outperform every single year. So I think many of you have been diversified across 3 to 4 asset classes. I think that's very healthy. It does help to create a more smoother investing journey. So whether you're young or old, I think understanding and diversification is important.
Thanks, Audrey. Alvin, I'm going to come to you for the next question. It's going to be about precious metals. But first, quick poll for the audience. How many of you have bought gold this year? Only a small handful. Put down your hands. How many of you want to or are thinking of buying gold now? Oh, also a very small number. Okay, because
Everybody
there is...
shy.
I'm asking this because there are literally 5 questions here about gold. And and there's more coming in. So it's already, I checked the numbers. Last night it fell by 5%. So year to date, up 53%. So I'm going to start with Alvin now. I'll come to Vasu and Audrey for your thoughts as well. Alvin, too late to jump in on gold?
This is not financial advice, but
Just your thoughts.
Make sure your friend is not in the room, you know, you want to tell him not to buy gold.
I actually did a small study on it, right? So the thing is that you have to look at the overall asset allocation, which I believe both speakers has mentioned about that already. It's not like you should go all in gold or none at all. It is always what is your allocation to gold that's going to be. And usually for financial advice perspective, you should not have a very big allocation to gold, right? You should have some, and maybe ballpark figure 10%, right, for example. And then maybe the rest, you do a bond stock kind of a typical allocation. And I did the study, and over the last 20 years, right, so by having 10% of your investment in gold, it will boost your portfolio returns per year by about 1%. It is not life-changing, right? And it does improve your diversification. That means it lowers your volatility of your overall portfolio. So it does have benefits. But is it going to are you like very worse off if you miss this year's gold rally? I don't think so, right? If you have been responsibly allocating a good amount to diversify, right? Not 100% all in gold, okay? That to me is not investing. That to me is almost considered gambling. You have to get the timing right? It's almost like you want to get into the hottest asset at the start of the year. And Audrey always show you it always changes. And who can tell me what is the hottest asset next year? Then we can buy now. Correct? We can't, right? So that's why you always have to diversify in the portfolio and be responsible with the allocation. Yeah, that's my view on gold.
Thanks very much, Alvin. Vasu, I'm going to come to you. I'm sure you've had quite a few of your colleagues and clients coming to you and asking you about this.
So again, you know, I agree, Alvin, you should manage your gold exposure within a diversified portfolio. Because, I mean, I spent 40 years in the markets. I've seen the dot-com bubble burst. I've seen all kinds of bubble bursts. And I've seen people fall in love with their investments only to be heartbroken, right? So never fall in love with something as far as investments are concerned. Fall in love with people, fall in love with loved ones, you know, sure. But investments, so I think our view on gold is we see more upside, right? We've just upgraded our forecast for gold to 4,006 per ounce. So we see more upside in the next 12 months. And our forecasts in some ways are conservative because there are others out there looking even higher numbers. But, you know, we think that, you know, central banks have been going to go ever since 2022. The Ukraine war, I think central banks have kind of lost faith in, you know, US sanctions. And so you see them piling into gold. So you look at global reserves of central banks, a large chunk of it is now gold. I believe something like 20% of it is gold, right? So central banks continue to buy gold. I think what has happened in the last few months is some degree of loss of faith in fiat currencies, right? Because if you look at the US, you look at Europe, look at other parts of the world, they're all running budget deficits and they're all talking about spending a lot more money and increasing their debt levels. And so that has also affected the confidence in fiat currencies, which is a positive for gold. Third factor is geopolitical risk. It's going to be there for quite a while. Right? You just look at the next 12 months, 18 months, 24 months. Things will happen. The midterm elections in the US are coming up. Jerome Powell is going to step down as Fed chairman. Will Fed independence be called into question, which is going to be a tailwind for gold? And other things. Trump's you know, huge tax and spending bill is going to kick in next year. The focus could go back to fiscal sustainability of governments around the world. So there are enough drivers, we think, for gold prices, we think, to head higher. But gold is a very volatile asset class, as you just said, you know, it's pulled back 5%. So, you know, you also want to manage your exposure. And our view is that, you know, yeah, it's a bit overextended right now. It's gone up quite a bit, it pulled back. And, you know, we think that, you know, the best strategy is basically some kind of dollar cost averaging strategy. But we think that it's useful to have some gold in your portfolio, but to manage it to a small amount, not have 40% of your portfolio in gold. I don't know, I mean, Audrey can probably tell you a bit more about that, but, you know, somewhere in the region of maybe 10% or so, I'm not sure. Again, depends on your risk profile, right? But, yeah, overall, we think there's a case for gold. There are enough structural drivers to possibly send gold higher over the next 12, 18, 24 months.
So it's like MSG. A bit is good, too much is bad for you.
Exactly. Too much is bad for you. Again, as I said, you know, don't fall in love with MSG, don't fall in love with gold as well.
Audrey, your thoughts?
Okay, firstly, I don't have 40% of my portfolio in gold. But I guess gold is like top of mind for many investors today, right? Our view on gold is that it's probably going to trade around this 4,000, 4,003 range, so slightly more subdued. But many of the factors that Mr. Vasu mentioned around central bank buying, the fear of US assets becoming less relevant, the fear of debasement, that has led to many participants worldwide stocking up on their gold supply. But one thing I read recently that I thought was quite interesting is that for many of the people who have been buying gold, they've been obviously buying gold over the years, many of these central banks. Currently, we are sitting on about $17 trillion worth of profits in gold. Right, and these are, you know, a lot sovereign wealth funds or maybe central banks who have been buying it from 1,005, 2,000, all the way up to where it is today. So if we have $17 trillion worth of profits in gold, just a 2 to 3% rebalancing in that gold allocation, just that alone is going to double the supply of gold in the market from a mining perspective, because at the end of the day, gold needs to be mined. And so just 2 to 3% of rebalancing of these profits is going to cause large kind of supply or influx of the precious metal in the market, and that could be a reason for a potential cyclical pullback, especially going into the end of the year. I mentioned earlier around midterm elections. So next year, this year, a lot of the people who have been buying gold are largely people who have been very concerned about the relevance of the US, the relevance of, US assets down the road. These are the people who have been buying gold. Next year, going to midterm elections, if there should be outstanding economy, you see less of the trade-related headlines, there could be some cyclical pullbacks as well. At the end of the day, I feel like when it comes to investing, it's not wise to overpay for anything, especially an asset like gold. Like what Alvin says, it doesn't give you yield, it doesn't really give you anything. It has inherent value, but that's all it does for you. So it might be a kind of costly mistake to try to chase gold prices at 4.3, 4.4, etc.
Thank you for that. So moving from one sector that doesn't really give you much yield to another sector that is very hot but also doesn't give any yield, we're talking about AI. So there's a lot of investment in it, but we're not really seeing profits from these big AI companies. And now there's genuine concerns. A lot of the questions here about the AI being a bubble, because recently there's been these worries about AI being a very circular economy, NVIDIA basically funding itself by investing in other AI-related companies. So I'm going to open this up to the panel. What are your thoughts about AI? Is it a bubble? Should we be worried? Alvin?
I think it is a bubble, but bubble can go a long time without bursting, right? So one example is a lot of people have been looking at the US market and have been calling US market expensive, and every year it just keep going up. And I think I also like what Jeff Bezos says about this AI bubble. In fact, he also acknowledged that it's a bubble, but he said that it's different kind of bubble. It's industrial bubble, which is good for society, right? Because in the end, there is progress for society. There will be a lot of productivity unlocked, especially in Singapore, where our manpower is getting older. Our younger workers are shrinking, and that's where the productivity gains from AI will be very important. And that means that it is not something that is like a very speculative kind of bubble, right? There's two kinds of bubble in this case. One is financial, one is industrial. So I guess what most people are looking at is more of the financial bubble. And I do agree that it is really concentrated and it seems overstretched in terms of the valuation. But at the same time, you can see that the Magnificent Seven or the AI-related stocks, they do have earnings growth, right? And yet the earnings growth is also very concentrated in this group of companies. If you strip them out, the rest of the S&P 500 earnings growth is actually not as fast. So it's very hard to tell, right, whether it's a bubble. I would say that end up, you still have to be invested most of the time, because the upside is usually a lot more rewarding over the long run. It's hard to call a bubble. Imagine if, let's say, you sell it now and US market continue to bubble for another 5 years. How are you going to get in, right? You're going to miss out a lot. So that is why I don't think we should think in terms of whether it is a bubble we should sell now. Nobody knows. Yeah.
Audrey?
I think, like what Alvin mentioned, the real use cases are there, right? So because of AI, it's been disrupting so many different industries. The tech industry aside, for example, if you look at medical technology, right, that a lot of AI influence has also crept into this healthcare sector. For example, if you look at robotics, nowadays operations that are done worldwide, about 5% is being fully carried out by robots. Right? So all of this have been enabled by all these AI and tech-related services. And recently with COVID, just a couple of years ago, what used to take what, 5, 6, 7 years for a new vaccine to be developed and tested. It took just a couple of months during COVID because AI was able to help with data mining, was able to help with increasing the efficacy of many of these vaccines. So I think the real use cases for digitization, for AI is becoming a lot more prevalent, more widespread compared to if you look at dot-com bubble, which is what everybody likes to compare it against. I think during the time of dot-com bubble, the internet or mobile phones is not as prevalent. It's not something that every single individual has access to at that point. And there was a lot of debt being raised during the year 2000 for a lot of these companies, IBM or Microsoft or whatever. A lot of these companies were raising a lot of debt that got to very unsustainable levels. But if you look nowadays at a concentration of the mega cap stocks, a lot of them have actually been paying off debt. They've also had many earnings revision upwards, right? So like what I kind of shared earlier, it is quite ironic, but many of these growth or AI companies investors have started to look at them that, they are actually having some defensive characteristics because of the improving fundamentals of these companies.
Thank you for that. And it's interesting you mentioned the dot-com era. So Vasu, I'm not looking at you just because of your age. I've been reading about Alan Greenspan back in 1996, Vasu, and they said that he mentioned that he felt that tech stocks were very frothy. He was worried about the valuations. And then 2 years after that, the Nasdaq had doubled since because he was calling for a bubble at that point. But then over the next 2 years, the Nasdaq, the tech index, doubled after his comments. And 1 year after that, then finally the bubble started to burst. So some people are saying, yes, there's a bubble. And as Alvin and Audrey have mentioned, maybe there's quite some way to go. What are your thoughts on this? Do you see echoes?
Yeah, this is a complex issue. I mean, I lived through the dot-com bubble, and so I saw prices pull back very sharply. I saw investors put 70-80% of their portfolio into technology stocks in 1999, 2000, only to regret it. So I think, is this a bubble? I mean, the dot-com bubble, during what I saw then, a lot of companies just added the word .com at the end. They call themselves technology companies, .coms, and that's it. Price just went up.
.com, remember that?
Exactly. So it's crazy, But this time around, are we in the same situation? I don't think so. I think there is real use, real application of AI. It is not just, a relabeling of companies. There's real use applications. I think the issue here is it bringing about the kind of productivity gains we're talking about? Is it transforming us in a big enough way? Right? I think it is not yet. It is happening. It's slowly, gradually happening. You've seen, the benefits of AI trickling through in many industries, perhaps not to the extent we want to see it happen. But then again, to me, AI is a super trend, right? And you've had a few, if you go back to the technology space, right? Mainframes to PCs, right? To the internet, to the use of mobile phones. The gap between each of this has been between 10 to 15 years, right? And the AI super trend really began in 2022, at the end of 2022, and ChatGPT was effectively launched, right? And so it's a super trend. It's probably going to last for the next 10, 15 years, I feel. It's going to change all our lives quite dramatically. The way we live now is going to be quite different from the way my kids will live 10, 15 years down the road. It's going to change things, right? But along the way, there'll be bruises and bumps and trips and falls and, over-exuberance. But I think the benefit, what I've seen is regulators, investors, central banks, they've all learned their lesson. They've got the benefit of hindsight. And so this time around, it may not be as bad. But having said that, I would definitely not advise putting a large amount of money into AI. Again, like gold, you want to manage it within a diversified portfolio, right? And you must be ready for volatility and pullbacks in the market. I think that's going to be the norm. This is a risky asset class, and you must have the patience and the time frame to ride through it and not over-invest in it and be prepared for the volatility. But I think this is for real. There are enough players, enough governments, enough regulators putting their buck behind the trend. And of course, everybody's in discovery phase. But as I said, 15 years down the road, hopefully I'm still alive, and hopefully MAS will still invite me. You might not see me sitting on stage physically, you could see me, doing this seminar from my home, right? So things are going to change quite dramatically. And I think, but short term, of course, things have run up so much, you want to be careful.
I think it's always nice to see you in person. I think we all prefer that after COVID. I think the next question we do have to talk about, and quite a few people have asked about this. The big news yesterday was the forecast that was put out by DBS that by 2040, the Sing dollar is going to achieve parity with the USD. So in English, 1 Sing dollar equals 1 US dollar by 2040. So that's the forecast. It hasn't happened yet. That's in 15 years' time. They believe this will happen. So for the panel, the question is, what does that mean? What would that mean for Singapore and our economy?
Any of you want to try?
They always leave the most difficult question to me first.
Always make you start first, sorry.
By the way, we didn't do the research, so we won't have the data to back whatever we say, right? So I would just say that anything is possible, right? Even a US dollar, Sing dollar parity is possible. I don't know whether you all remember many years ago, Aussie used to trade stronger than Sing, right? And now it's the other way around, okay? And there was a period where I remember Aussie dollar deposit was giving higher interest rates. And a lot of people flocked from Sing to Aussie to put in a deposit. And it's so-called safe, right? Because it's fixed deposit. You can't lose the principal. But what actually happens when Sing dollar strengthened against Aussie, the forex loss was actually greater than the interest that was collected. And end up, when you convert back to Sing dollar, you have less money. So I would say, using this example, that anything happen, right? So I also believe that our nature of our Sing dollar has always have a very good track record of strengthening due to the nature of our situation, right? We need a strong Sing dollar. It always appreciate gradually, I would say, right, over time. So I believe I live long enough to see that day to come. Yeah.
That's a great answer. Audrey?
Okay, so US Sing, we are in a very fortunate position, I think, to be in Singapore because we are one of the many countries out there where we actively kind of intervene in the strength of our currency. Not many countries are able to do that. Right? So I think when it comes to dollar Sing as a currency pairing, because this basket that we measure the Sing dollar against, I mean, like MAS event, I don't know whether I should be saying this, but the basket at which we measure our currency against, a large bulk of it is US dollars. And as we all know, we are a very kind of export service oriented economy, and having a stable Sing dollar is very, very important to us. So when it comes to US dollar and Sing dollar, I think for many of us as Singaporeans, we don't have as big a risk to worry about compared to, for example, if you were in Switzerland or if you were in like Japan or Australia, etc., where we have seen huge fluctuations in the dollar yen, in the Swiss franc, So I feel 1:1 is probably going to be it's going to be very challenging for our local economy. Yeah, and
It's not really a good thing for us, for our currency to be that strong, right?
yeah, I mean, at the end of the day, a lot of trade is still carried out in US dollars. That's why it's still the reserve currency. So call it about 60 to 70% of world trade is still being settled in US dollars. So the relevance of US dollars as a reserve currency will probably still be quite valid in the coming, call it 5, 6, 7 years. The next currency that is where trade is often settled in, probably in the commodities, would be the renminbi. But we don't really see the Chinese yuan becoming a frequently or globally internationally traded currency because of how the government is structured. So we think that in the next 5, 7, or even 10 years, the US dollars could still be the reserve currency of the world. And it will be difficult for Sing dollars to go to parity because of the construct, the services, the export industry for us.
Yeah, thank you. So very good reminder for us. Reality check, it's just a forecast. It's not happened yet. So it may not happen. It may happen. We don't know. Vasu, I'm going to come to you. Do you want to talk about this or you want to talk about China? That's the next question.
Maybe I think enough has been said about we can switch topics.
So,
I'm not trying to run away. I mean, I think, I'll try and cover as much as we can.
So, we have to talk about this because China is the second largest economy in the world. It's Singapore's other big partner in the world. We have over 1 million Chinese nationals working in Singapore. We have very close ties to China. Is it worth investing in the country? Because I'm asking this question sort of in the context of, in the past, there's been a lot of concern about government intervention in a lot of these large companies that are listed from China. Is that something we should be worried about, or is China a necessary part of our portfolios?
Okay, I think it's a good question. It's in the same vein as gold, AI, China. And of course, you can add other things along the way. But I think, these are all very volatile asset classes. China especially, a very volatile asset class. So again, there is a case for investing in China. We are overweight Chinese equities. We have been overweight Chinese equities for, I think, the last year or so. We've not been wrong, because Chinese equities have done very well in the last year or so. So we called a buy, I can't remember exactly when, sometime last year, when the markets were close to the bottom, I think May or June last year, and things have done well. We remain positive on Chinese equities. We still think that, there's more upside. But again, we always tell our clients, please do not overinvest. Manage it within a diversified portfolio, just like AI, just like gold, just like anything else that looks really sexy, right? Just be careful about it. But we think there's a case, but with China, with the equity markets, it can swing up and down in a very significant way, right? I think if you look at in China, I mean, I can go on with a lot of arguments about China, but one of the arguments is that if you look at the amount of savings in China, it's massive. The Chinese are sitting on a massive amount of savings internally, right? And, essentially the property market doesn't look like an investment opportunity. They are buying gold, which has helped gold prices go up. And they're also buying equities. They started buying equities. But if you look at the percentage of typical Chinese households' exposure to equities, it's still very small. I think it's less than 10%. If my memory serves me right, it's somewhere in the region of 5 or 6% or so. Now, if you look at the US, the exposure of equities in a typical household is much higher. If I'm not mistaken, I think Audrey can correct me, maybe it's like, 35, 40% or somewhere around there. So the Chinese investor has not really gone into the equity market in any big way, right? He's been invested in property, which has led to a bad experience. But, I think they're slowly, gradually getting in there. And so there's a lot of firepower that could support. And, we've got the 4th plenum in China that's taking place right now. They plan for the next 5 years. And, China is in a good shape. I mean, I think we are slowly coming to terms with the fact that economy is not going to grow at 8% anymore. Probably 5% or there is good enough, right? And the property bubble is overhang, but I think hopefully it'll clear in the next 5 years, slowly, gradually. But again, I think with China, you want to invest carefully. But, I think it's a market with a lot of potential, just simply because look at the amount of savings in China relative to the stock market and relative to the exposure of Chinese households to the equity market. I think there's more upside.
Thanks, Vasu. I'm going to go to Alvin on this because I'm on his Telegram group for Dr. Wealth, and they publish a weekly China update. So I'm sure you have some insights on this. What are your thoughts on investing in the Chinese market?
I think it's a very understood market. Right? Not enough coverage in the China market. I think there's a lot of misunderstanding going on. So that's why I do my best to give a bit more coverage on China. Because today you go and look at the media, usually they'll talk about US, right? It's very, very common. So I think there is a mismatch in terms of the information that's available. And I also know that a lot of people nowadays don't really read Chinese stuff, right? So a lot of the Chinese words, we have forgotten how to read them. And a lot of all this information or news are coming from the Chinese side. Of course, barring the fact that there will always be biases, right? Whether is it Western media covering China or China themselves covering China, there will always be a bias. And it's always important to, when you invest in China markets, be aware. The information bias, I will say, is a lot stronger compared to other country coverage. And that's where you need to read both sides, right? And then you need to be having some critical thinking to get a sense whether what is really going on, right? Rather than just blindly listening to either side of the story. I agree with Vasu, right? So it's all about allocation. You should have some exposure to China. The question is how much, right? So different people at different comfort level. Some people have more confidence in the Chinese potential. Some people have less. So you just tailor accordingly.
quite unique also, right? And I don't know whether Audrey wants to take this, because one feature of the Chinese market is that the retail investor participation in the Chinese market is a very high proportion, is actually the majority of the volume of trading that happens in the China markets comes from retail investors rather than institutions. Audrey, do you want to chime in on this?
I think whatever you've mentioned is more prevalent on the onshore space. So when it comes to China, I think there is a need to distinguish between onshore China A and then offshore China H as well. Net, we feel that, in China, they are finally pivoting to growth. They've kind of taken quite a few years to sort out their domestic, social, or property-related issues, and now they're pivoting to growth. As long as the G2 polarization is going to be a central theme for the next coming few years, the relevance of China is going to be there.
Sorry, I have to ask you about the G2 polarization.
Okay.
Could you just explain that to us?
Sorry. Okay, so we think that between the US and China, they used to work together. I think moving forward, there's going to be a separation in terms of how business is being conducted. And so because of that, as we know, a lot of things cannot go into China from the US. China is going to need to become a lot more self-reliant. The industries that are focused on this would be the onshore China A, which is what, Edward, you mentioned around being more retail focused. So the onshore market is 80% retail driven. So it's literally people talking to each other. Like you said, your friend will text you and ask you, should I invest in a particular stock? A lot of that is happening on the onshore China space. This year, we've seen a lot of activity on the offshore space where more international investors are participating in. So these would be Chinese companies that are listed in Hong Kong, the Chinese H shares. I think that has done some version of 30% this year. The onshore China has done about 20% this year. Both of them amazing returns, but I think in terms of like information, symmetry, transparency, the companies that are listed offshore where you have a lot more international participation, that could be an asset class that could be easier to interpret and to understand versus the local onshore market.
Thank you very much for that. We're running out of time, so one final question for all of our speakers. I'll start with you, Vasu. This is a CPF event, so I definitely have to ask this question. There's actually a question here, and this is for all of our panelists, from one of our attendees who's asking, why don't I just put my money in the CPF? I don't really know how to invest. I'm scared to invest. Is it a good idea just for me to just contribute the maximum amount to my CPF, if that's the case?
I don't think there's a need to be so extreme. I think it's not mutually exclusive. CPF is a safe haven. It's like putting your money into deposits. I mean, for someone like me, CPF is as good as a deposit account, right? But for somebody who's much younger, you still have some ways to go to hit 55 before you can take your CPF money out, right? Gives you 2.5%, for 60,000, 1 percentage point more. So, but I think, is 2.5% going to cut it to meet your life goals in the future? Your children's education, your retirement, and so on and so forth. I would think there is some room to be a bit more active and maybe aggressive. And of course, put your money into CPF, treat that as perhaps a safe haven. But at the same time, I think it's important to invest. Just because you're fearful, it doesn't mean you shouldn't invest. I think it's important to get up to speed, attend seminars, read up, attend classes, slowly put your foot back into the market. I think it's important because that will give you better returns than just 2.5%. I'm not saying don't put it in CPF. I think it's not mutually exclusive. You can put some in CPF as well as invest some. Never a case where it's just this or that.
Thank you, Vasu. Audrey, your thoughts, and maybe you can talk a bit about SRS also, if you'd like to.
Sure. Okay, I think, so CPF this week has just been announced by CNBC and Bloomberg and a lot of other news agencies that we are the best pension system in Asia Pacific. So please put your money into CPF.
Whoa!
Okay, but that aside, I think what Mr. Vasu said around not being too extreme is also relevant. We have seen that the cash return has been about 1.8% over the last 10 years. CPF doing some version of 2.5%. I think liquidity is very important. So for us who are not able to take money out of the CPF yet, we have to take that into consideration. You mentioned SRS, so I think the availability of instruments are also quite important because understandably, the money that you can use in your CPF to invest, the range is a lot shorter because there's a lot more stringent guidelines to follow. So a lot of the investment options that were shared today around, for example, AI, around gold, around healthcare, etc. These may not be available on the CPF or on the SRS platform. So SRS is great from a tax perspective, but also the monies that are currently in SRS not really necessarily earning anything. The vehicles to put the money into is a lot more limited compared to what is out there. So now our world is increasingly hyper-connected. It's good to have a bit, dip your toes into all the different asset classes to see what works out for you. And of course, consider your own personal financial situation. If you want to buy a house in 2 years, we should start planning for that 1-2 years in advance because, most investments need a certain runway to come to fruition.
And on that topic, don't anyhow put your money into SA from your OA. If you're going to buy a house, you need that money. It's a one-way street. You put into SA, that's it. Okay, it's not going back into your OA. Alvin, so this time I'm giving you the final word, not asking you first. Your thoughts on the CPF as part of our portfolios?
From a financial planning perspective, right? So CPF has always been a very good foundation layer as a secured cash flow during your retirement. So how you can see it is that you think about what you really, really need in terms of expenses when you retire is an X amount, maybe, I don't know, $3,000, non-negotiable, right? So you have to spend this in order to pay your utilities, pay whatever you need on your food, your transport, everything. And that can be that layer that the CPF Life payout can be that part that supply the cash flow to pay for these necessary expenses. And you can use the CPF Life calculator to measure, right, how much you will actually get eventually as an estimate, and then you see whether is it enough for you, right? If you feel that it's not enough, then I think you can do CPF top up and to make that minimum non-negotiable payout when you retire. And after that, beyond that, of course, you can use your cash to invest to get higher gains so that you have more buffer. Maybe you can go for more holidays, further holidays, right, when you're retired, right? Because your needs are settled. And your investment that comes from your cash returns will fund for whatever you want in life, right? So I think that can be a way that you can complement our national policy, right, with whatever you want to invest as well.
Thank you very much, Alvin. Thank you to all of you for submitting your questions. Please give a big hand to our speakers, Mr. Vasu Menon, Ms. Audrey Ho, and of course, Mr. Alvin Chow. Thank you very much.